Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Range Resources CORP quarterly report. Range Resources Corporation offers a diverse range of businesses and services, including exploration and development of natural gas and oil properties, acquisition of new natural gas and oil properties, sales of, plus natural gas to utilities, marketing companies, midstream companies, and industrial users, plus NGLs, natural gas liquids, to petrochemical end users, marketers/traders, and natural gas processors, plus oil to crude oil processors, transporters, and refining and marketing companies. Range Resources Corp's stock price has increased by over 12% in the past year due to several key factors. The company reported robust Q3 2025 earnings, beating analyst expectations for both EPS and revenue. This marks the fourth consecutive quarter of exceeding consensus estimates. Additionally, Range Resources generated strong cash flow from operations and returned capital to shareholders through share repurchases and dividends. CEO Dennis Dignur expressed confidence in the company's position amidst increasing demand for natural gas, citing strategic investments and operational efficiency. The company also extended its credit facility and adjusted its capital expenditure forecast, indicating efficient capital allocation. These positive developments have contributed to a 19% increase in stock price over the last 12 months, with analysts expressing optimism about the company's future prospects. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by an increase in net realized prices, higher unrealized derivative fair value gain, and a significant increase in average realized prices for natural gas and total production. Additionally, higher commodity prices and increased broker purchase volumes have contributed to the revenue growth. On the other hand, revenue decline is mainly attributed to a decline in production for oil sales, lower NGLs prices, and lower interest income due to repayment of senior notes. Net income and profit margins experienced significant growth between September 30, 2024 and 2025. The company's net income saw substantial increases. For the 3-month period, it rose by $93,651 to reach $144,307, representing a staggering 185% growth. Similarly, over 9 months, net income surged by $307,439 to $478,937, marking an impressive 179% increase. Profit margins also witnessed significant improvements. The net income margin for the 3-month period jumped from 8.2% to 19.3%, while the 9-month figure rose from 9.6% to 20.9%. These changes are likely attributed to increased revenue and or reduced expenses, as stated in the financial report, page 5. The company's financial performance indicates a strong ability to generate operating cash flow. According to the provided information, the company has consistently produced positive operating cash flow, with specific numbers confirming this trend. As of September 30, 2025, the company reported an operating cash flow of $913.8 million, demonstrating its capacity to manage and generate revenue effectively. This positive operating cash flow is a key indicator of the company's financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, the bank debt increased substantially from $0 to $125,650. However, this was followed by a notable decrease in total debt from $1,697,883, December 31, 2024, to $1,216,767, September 30, 2025. The credit facility also saw an increase from $0 borrowed/repaid in 2024 to $885,000 borrowed and $756,000 repaid in 2025. Notably, the net interest expenses skyrocketed by plus 1,133% from $9,820 in 2024 to $110,561 in 2025. However, this was later offset by a decrease of 14% compared to the same period in 2024 due to lower debt balances. Furthermore, interest expenses decreased significantly in both the third quarter and first 9 months of 2025. Overall, while there have been fluctuations in debt levels, the most striking change is the substantial increase in net interest expenses followed by a subsequent decrease. The company's financial performance reveals areas of concern. The Appalachian region and ethane sales agreements in the Marcellus Shale area have underperformed, indicating potential issues with regional market demand or operational efficiency. These segments require attention to improve overall financial health. Management's outlook on company strategy. The company has a positive outlook on its financial instruments, with carrying values approximating fair value. Management also believes that reserves for certain legal proceedings are adequate, but notes that additional losses are reasonably possible. In terms of strategy, the company is focused on building stockholder value through returns-focused development and consistent cash flows from reserves and production. To achieve this, management plans to optimize its transportation portfolio, manage challenges through disciplined capital investments, maintain a competitive cost structure, diversify sales outlets, and manage price risk. The company also expects commodity prices to remain volatile due to complex supply and demand dynamics. However, management is optimistic about the future, citing opportunities for growth in suspended wells and infrastructure expansion. In terms of capital expenditures, the company will prioritize projects based on commodity prices, infrastructure availability, and supply and demand fundamentals. Management notes that revenues and bank loan availability will be affected by changes in natural gas, NGLs, and oil prices. The company has made several acquisitions and divestitures in recent years. Acquisitions include the purchase of acreage for $51,499 in 2025 and $44,787 in 2024. Divestitures include the sale of North Louisiana assets in 2020, as well as the disposal of other assets worth $161,000 in 2025 and $273,000 in 2024. Additionally, the company repurchased its own common stock and senior notes, paying off a significant portion of debt. The company has demonstrated a commitment to returning value to its shareholders through two key initiatives. Firstly, it has paid dividends, with a total payout of $21.4 million, as noted on page 28. Secondly, the company has also engaged in share buybacks, repurchasing a significant number of shares at an aggregate cost of $176.6 million, as detailed on pages 24 and 29. That concludes the financial summary for Range Resources CORP. Feel free to comment below, and I will be happy to answer them when possible.